Good evening, everybody. Thank you all for coming to our 2015 investment conference. I'm Ron Redfield. Hi. Don't be intimidated, please, by this big, well, I'm not going through all this, but it's good to know, and a lot of it's from last year, and I'll update part of it. The first thing I want to do, and here's our office building on South Avenue. Feel free to stop by anytime. Feel free to grab some coffee on a nice day and sit in one of our Adirondack chairs and read. And we have plenty of reading material if you don't have your own. I'd like to introduce my partner, Alan Starinsky, spelled Star in Sky. And he runs our accounting and tax division. And I run our investment division. We've been working together for 28 years, since Alan started in 1987. I've been there for 32 years. I'd like to introduce our staff. I missed them last year because they were on a separate slide. So this is Denise Acasella, one of our accountants, Jim Katz. And then we have Donna Wisniewski. We have Chris Marigi. Arlene, Chris has been with us since 1983. Wow. Donna's new, she's been with us since 1998. Arlene Schmenko, she started with us in 86. And Chris started in 84, right behind me, right after me. And Debbie Kowalski, also a newbie, who's only been with us 9 years. And that's also a picture of my dad, who started the firm, and he's no longer with us. So all of us together have worked 184 years together, the 8 of us. It's a long time, and it is whistling while you work. I'll just skip this. This says I eat my own cooking. My family's portfolios are invested just like all of our clients' portfolios. These are our returns through October 31st. I always like to present them against the Tweedy Brown Value Fund, just because we try to think of ourselves as value investors. It's tough to compare to the S&P 500, not because we're trailing them over the last 10 years, but we're far exceeding them longer than that. But we're really trying to stay defensive in our investing, and we're not always in S&P, where we have a lot of other positions. Historically, we've had fixed income in our portfolios, but with today's interest rate environment, we've been avoiding fixed income.
Ron, excuse me?
Yes, sir.
I'm not familiar with Tweedy Brown. Can you explain a little bit about that organization and why they're represented here against what your organization does?
Sure. So Tweedy Brown is just an old-time value fund. There's different types of investing. We practice, and I'll talk about it tonight a little bit, okay, of what we think is value, what is value investing, and trying to buy something with a margin of safety, some type of cushion below you, and so forth. So Tweedy Brown Value is just a fund that I've just looked at for many, many years, and they've been around for a really long time. Okay. So an old, stodgy value fund. That's,
okay. Thank you.
Yeah. A lot of this is on our website and so forth, and I'm not going to go. This is very similar in the beginning to what we did last year, so I'm not going to redo what we did last year. But this is a big theme of ours on this page is, no, we don't believe anybody can predict over the short term what can happen. Oh, what do you think will happen to the Dow this year? It's a crapshoot. What do you think will happen with our stocks over the next 5 or 10 years? I think becomes more predictable as companies generate cash flow, earnings, reinvest properly, hopefully. and so forth. So how will the market do over the short term? We always answer, it will fluctuate, and that's, JP Morgan did that, so that in the early 1900s. This is an interesting slide. Before I go here, I wanted to, I have a speech prepared, which I totally avoided as I went through this. And I wanted to first say, so let's even avoid this for now. What I really wanted to say is, thank you all for coming. And I find this annual event, which now we've done it not annual, we've done it maybe 6 times over the last 10 years or something like that. But we're going to be doing it every year because I think it's important that our clients get to ask questions, get to see us, and get to feel us as how we are as people, as investors, as a group that is taking care of your livelihood, your financial livelihood. And we understand the importance of that. We understand we're the stewards of your capital, and it's very important to us. And you guys, our clients, come first. Whatever we do, whether it works out or not, we're doing it with the best intent for our clients. Often it works, sometimes it doesn't. Hopefully when it doesn't, that's a temporary situation. So I'm very, very cognizant of our duty towards you all, and our responsibility. During the conference, you'll see me look through my notes if you have questions, and I don't necessarily remember details. Funny enough, I remember meeting Mr. Zambrano in Cranford probably 14 years ago at a street fair. I remembered Mr. Ford, a retired aircraft airline pilot for Continental. I remember so many things other than exact details. I know Microsoft like the back of my hands, and I know whenever I say Microsoft, my son Dylan, who's a computer science person, cringes.
As you should.
But I couldn't tell you what their earnings will be and so forth without looking at it. I carry a notebook wherever I go. I'm always taking notes because I forget things. I have an app for remembering things. I have to-do lists. Kim, my wife, wanted me to do something. Just email me. I'll never remember otherwise. So hence, I'll look through my notes if need be, and I'll let you know. Now we can go to this important slide. Something very interesting. Over time, and even over time, dividends have typically been, let's say, 2/3 the rate of the 5-year Treasury. And in the year, in the tech bubble of 1999-2000, one of the concerns was the dividend rate was so low and compared to interest rates and so forth. And I don't think that was necessarily the cause of the crash, but it's often been the case. I don't ever recall a situation where the average dividend yield of many companies is on par with a 30-year Treasury, much less the old 5-year Treasury. So what you see here is right now our expected dividend yield as of last month was 3.1%. And the reason it's higher than normal is we do have a concentration of utilities and energy companies. The energy, now it's expected dividend yield, it's based on the past. I wouldn't be surprised, and we'll talk about this, that energy companies through through the price of oil going down almost 2/3, if not 2/3, I expect there'll be some dividend cuts. So I wouldn't count on 3.1% in the future, but certainly 2.4, 2.5%. But what's very interesting is, with a 5-year Treasury at 1.6%, a dividend yield of, let's say, 1.2% would not be so low. So now we have a dividend yield of 3.1%. I think most dividend payers are probably greater than the 5-year Treasury. And for the first time, we see that the dividend yield is really about the same, if not a touch higher, than 30-year Treasury. A very interesting scenario. Now, much of that is probably because of the unusually low interest rates, which potentially are temporary. You'll see later on, we're already seeing little inklings of interest rates going up. But think about it, a 30-year Treasury, 3%, that's a little risky, I think, to tie up your money in such high quality for 3% for 30 years. But it is high quality. This is something I want to spend a little time on. And many of you might know this, but this is one of my favorite parts of investing, or favorite things, is the Rule of 72. And basically, what the Rule of 72 is, it's a generic back-of-the-envelope way to estimate how long it will take to double your money. And what return you need. You define a rate of return you're looking for, and basically, let's say that rate of return is 6%. So the Rule of 72 uses 72 as a numerator, the top part of the fraction, and 6% would be the denominator. So 72 divided by 6, you'll double your money every 12 years. What's interesting is the 3-month Treasury has always been around 6% over history, which you'll see later on. And it used to take that 12 years to double your money. And I will say I have a typo here. The 3-month Treasury rate is not 0.0113. The 3-month is 0.113. So I'm wrong. It will not take 6,300 years to double your money. It'll only take 637 years to double your money, using the Rule of 72. What's interesting, though, is just a few weeks ago, it was at 0.01, and for a few days in October, the 3-month Treasury yielded 0. Very interesting. Last year at our conference, the rate was 0.013, and it would have taken 5,538 years to double your money. Probably worth waiting for, but not what we could do. Be careful what you wish for. The 10-year, it just so happens that the 10-year Treasury over history is also, by ballpark, just looking at the charts, has averaged about 6%. So you double in 12 years on a 10-year Treasury. Well, now the 10-year Treasury is 2.28%. So it'll take you not 12 years, but 31 years to double. A 5-year CD has historically paid 6% since they've had CDs. And I believe they started in 5-year CDs in 1984, if I'm not mistaken. Well now, so 12 years on average to double your money in a CD. Well now the average 5-year CD is 2.75%, so it takes a little greater than 26 years to double. Does everybody understand that concept? So if you have a rate of return of 10%, it will take 7.2 years to double. It's just an interesting, I find it real interesting. I mentioned this last year, and I altered the slide a little bit. I still believe bonds are a risky, not for principal, but for return. it's set up, I believe we're set up for poor returns going forward, because if interest rates go up, bonds will lose value. The beauty of bonds, though, or quality bonds, let's say treasuries, is you will get your principal back no matter what. If we don't get our principal back from U.S. Treasury, we probably have more concerns than money, money alone. But so you really can't compare a U.S. Treasury, which you can't compare, let's say, you can't compare a utility that yields 4.2% to a 5-year CD that yields 2.45%, because the CD is FDIC insured, where a utility could lose value. There could be something happen to the utility itself, which could cause permanent impairment of capital. Not too normal, but you really can't compare the two. There's a time and a place for both of them. We do not, at this point, we don't invest in fixed income, and we tell our clients, if you need fixed income, you should get it on your own, because there's no need to pay us 1% to generate. You generate 1% return if you're lucky. On the same token, we see people promoting what are called safe, guaranteed investments for, let's say, 5 or 6%. And how does one get 5 or 6% when the 30-year Treasury is paying 3%? I don't know the answer to that. I think the answer is it truly doesn't exist as being promoted. On page 14, go back another time, you can see this is a 3-month Treasury rate since 1940. That's where I got the average of around 6%, just eyeballing it. The next one's a 10-year Treasury rate, very similar. Always, typically you're going to have the 10-year is always, the longer the term, the greater the interest rate, normally, not always. And that's the case now as well. We'll discuss this later, but here's our 10 largest holdings on page 16 as of November 13th. Interesting enough, after the close today, Walmart is now our 10th largest holding, and Exelon is our 11th. It just, it changes by the day, and because you see the percentage ownership is so close that a one day, today Walmart, it was unusual for them to come out with really good earnings and very powerful earnings, so their stock was one of the biggest gainers today. 10 of our top 10 holdings make up almost 55% of our assets. We prefer to have a lot less than the 30 holdings we have now, and one day I'd like to have less than 15, as we used to historically. But there's a reason for what we own, of almost all the positions we own.
Ron, excuse me.
Yes, sir.
You showed Gazprom in the top 5. Any specific comments on?
Yes. Gazprom is our 5th largest holding. If I recall, last year it was certainly in the top 10.
Of what? Top 10 of what?
Our top 10 largest holdings.
Right.
So Gazprom, not looking, just curious, clients of ours probably know Gazprom. A lot of people are not familiar with Gazprom. Is anybody not familiar with Gazprom and what they do? Okay, so very good, and it's common that people don't, but maybe those who invest with us. Gazprom is one of the largest oil and gas companies in the world. Give or take a few percentage points, 50% owned by Russia. I've studied Russia endlessly for this, and you'll see that later on in this conference. I think Gazprom's a good company. There's always a concern. Putin might privatize Gazprom. He might do awful things. Well, I don't think that'll happen. They're pretty friendly to the hand that feeds them. And remember, the USA almost did privatize our banks and our insurance companies in the financial crisis of 2008. It's happened here. Basically, shareholders were wiped out with the many financials in that period. Gazprom's fundamentals are very strong. Not as strong as Exxon, but let's keep in mind, Exxon, our top holding, is one of 3 non-financial companies that have a AAA rating. Now remember, the United States of America is I believe, AA-. So Exxon and Microsoft, both of which are one of our top 10 holdings, have AAA ratings. Johnson & Johnson, which we don't own, is the other company. Gazprom is a notch below investment grade by Standard & Poor's and Moody's, which are credit rating organizations. And it's interesting because if you look at Gazprom as a company, there's no way they should have a slightly reduced rating, perhaps than Exxon, maybe the same as Chevron, but they shouldn't have a junk rating, but they do. The largest rating agency in China, I think their name is Dagang, it's later on, that's where I would refer to my notes, gives them the highest credit rating. So it's interesting. So why do we own Gazprom? Is we feel it is well, it's certainly a large company. They make a ton of money, and we believe the shareholders will be rewarded. And I think part of the reason of the depressed price is because of the perception and fear of investing in an association of Russia. Very interesting. And as Dylan knows, we have many a dinner conversation about the government of Russia, really not Gazprom, and Putin, world events, Syria. It's a very dynamic situation, but that is why we own Gazprom. They pay a nice dividend as well. Like any energy company, they're having difficulty with the price of oil. But they're making money. They're doing okay. You hear a lot about Gazprom in the Ukraine. But the Ukraine doesn't always pay their debts, and there's this situation. What happens if somebody wasn't paying Exxon? They might be cut off as well. So it's an interesting thing to watch. It's also more difficult to follow Gazprom because if something happens with Exxon, we read about it. We read about Exxon and their potential of not being totally honest with the environment and what they knew just last week. You wouldn't hear that about Gazprom. They're too far away. Well, every morning I check the news services and I get news pushed to me on Gazprom. I'm not going to go through our investment strategy. We've been through it before. If anybody has questions, please let me know. These are from last year's handout as well. Once again, on this page, we identify, we really, comparing us to the S&P 500 we're too defensive for that. On the other hand, you can't compare us to a balanced fund because we have no fixed income. We have quite a bit of utilities and so forth, and we'll get in a little bit of that later.
Bob?
Yes, Sandy?
I have a question. Why do you say you want to reduce the number from 30, which is the current number you have, to about 15?
Because I believe in having all your eggs in one basket and watch that basket closely. So the less, the better. You can have a better handle, I feel, when we have less positions. And I do think that 10 or 15 positions is enough to have proper diversification. There's a term called diversification. Now that, of course, doesn't happen with 30. But it's a lot of work even to keep up with 30 companies and to know them well in the back of your head. So ideally, we've always been focused investors, concentrated investors. But right now, our conviction in one idea is not great enough to warrant 15 holdings. Years back, when Microsoft was in the low 20s, we had an excess position in Microsoft. Probably, I don't remember at this point, probably 15%. Same thing with Exxon a few years back. Both of those companies, as they ran up, we trimmed to near 5% positions. In retrospect, well, we shouldn't have, now Microsoft's doubled, and Exxon is right near where we bought it, although there has been a dividend. But, but still two holdings that I like a lot. The interesting thing about Exxon also, and I've always said this, and we'll go through it later, is Exxon has a if Gazprom traded at Exxon's fundamentals, it would probably not be a $4 company, but a $20 company, if they had the same price to sales, price to earnings, etc. But if you invert that and say, well, if Exxon had the same fundamentals as Gazprom, they could be a $25 company. So, it goes both ways. These are two big themes of ours that I think about all the time. I'm concerned with the ownership of bonds, unless they're held for term, till the term. If interest rates go up, a value of a bond goes down. Reason being is if you went out and got a CD today for 1%, a one-year CD for 1%, and all of a sudden interest rates went up and you can get a one-year CD for 3%, your current CD is going to be worth less money, just because it could be replaced at a higher interest rate. But it will come due. That's the difference. People who invest in bonds, just like anything else, get monthly statements and they see their value. I am concerned that there's so much liquidity in all the bond managers trading bonds and so forth that the pricing is a little fictitiously high. And if all of a sudden people want to exit bonds quickly, it's going to be a lot of people in a small funnel, and prices could get hurt badly. And often, as we did in the late 90s, we would be the buyers of those bonds. If we could buy treasuries in distress and get 6 or 7%, we would do it. But you can't do that right now. Typically, but not always, the companies we own have strong financial strength, such as Exxon and Microsoft. Most of, well, let's even, look at our top 10 holdings. Exxon, AAA company. Bank of America, look, every bank we have, maybe slightly excluding JP Morgan, had great pains in the financial crisis. But their capital, Bank of America, Citigroup, and JP Morgan, are all in our top 10, have strong financial capital base. The government gives them the stress tests and makes sure that under all circumstances the depositors get paid. Shareholders, they don't care about and they shouldn't care about. The key to the financial institutions, and AIG, our eighth largest, is included in that. The system only works if everyone gets paid, and that's what happened in the financial crisis. And everybody did get paid, but essentially all the shareholders of the other, everybody but JP Morgan got wiped out, basically. Citigroup, sure, they're selling at $53 a share when they were at, I think, 60 cents, 70 cents at one point. But I don't remember the exact amount, but it was like a 1-for-20 split, so they chopped up the price a great deal. Might have even been more than 1-for-20. But Bank of America is very strong. Something interesting with Bank of America and Citigroup is as they get stronger, and as they apply to the government each year, I believe the dividends will be raised dramatically as time goes on, if they keep their strengths. And they certainly, all their ratios are much higher than they were, and really the strongest they've been in. And they're just very strong financially right now, all the financial institutions, at least these.
Excuse me, I have a question if you don't.
Sure.
I had my Bank of America stock, unfortunately I sold it 5 years ago. I still have my Citi, so I'm glad, to hear this, but, those are the two banks that, I know out of all the banks that, have the best base, you were saying, because there's a lot of banks out there, I mean.
I wouldn't say they're the strongest base. JP Morgan's probably,
No, I mean, other than what's on this list.
okay.
Yeah, so you picked Bank of America and Citi and JP Morgan, about like Goldman Sachs or some of the others? No?
It just so happens that there's one other small bank we own just a touch of. It just so happens that these are only banks and financial institutions that we own. We never owned Goldman Sachs. I've looked at them, it just didn't do it for me.
Yeah, well, that's what I mean, obviously,
The reason we own all of them, Bank of America, JP Morgan a little different because they are a little bit stronger, but Bank of America, Citigroup, and AIG have their price to what their assets are, price to book value is quite low. Historically, all of those companies have sold at typically 3 times book value. I do have to look at my notes, but I think Bank of America has a book value of 22. So that means if they sold for 3 times book, it would be $66 a share and not the $17 a share now.
Right.
Now, I don't know where Goldman is on that, but it's just Goldman is just I never wanted to go there because we are in banks for safety and so forth as much as possible. And
No, I
there's a lot.
know what you're doing, I just
No, not
wanted
necessarily.
an education.
Look, Warren Buffett owns a lot of Goldman, although I believe he just sold a bit.
And Disney too is flying, I mean, from the time I bought it, that's,
Okay, good. I never owned Disney, not to say it's not, Once again, when we only own 30 companies,
Right.
and that's a lot for us, 5,000-10,000 companies you can invest
no,
in.
they're good.
Sure.
Yeah.
So once again, all of the companies in our top 10 are not all, most, are very financially strong and what I think are sustainable. Our third holding, PBF Energy, I wouldn't say they're as strong. They're a young company. They're one of the largest refiners in America, and they're getting bigger. They're buying quite a few. They're buying a few of the Exxon refineries and so forth. And when they're in such high growth and take on debt to get that growth, there's risk involved. But I do think it's, and we may or may not discuss PBF later, but so out of our top 10 holdings, I believe one is not financially strong. Okay. So. When we buy a position, time is a very important element. An investor must be patient. I believe Berkshire Hathaway has dropped 50% of value, maybe, I forget, it's in our notes somewhere, maybe about 10 times since Buffett took control of it. These things happen with companies. They go through, look at Exxon. Exxon hasn't dropped in half, but certainly 30% off its peaks, 35%. So patience is necessary. Things don't always come back, as one of our clients recently mentioned. We bought a company, within a day it was down over 20%. Well, had we known it was going to drop 20% the next day, we certainly wouldn't have bought it. Yesterday, when the company was down 25% off our purchase price, I said, you know what, I think I would buy it today if we didn't own it. And we do not have a huge position. And this is Valiant Pharmaceuticals, which you may have been reading about. Well, now it's, I don't know if we'll own it. We need more clarity on it. I was on the conference call. I was the one who asked, will they have any liquidity concerns going forward? And they clearly said no, but who knows? It's a work in process. I wanted to point out the price of natural gas. This is a 10-year chart. And I forgot to include my source, and it's NASDAQ.com. But the price of natural gas, we could see that's gone from a high of a little over 13 before the crisis to a current level of around $2.30, $2.40. What's so important there is utilities, which are a major holding of ours. The pricing that utilities charge is based on the price of natural gas. That's how the regulators base the utility pricing to us. It's funny, I hear people complain about their utility bills. Look at this chart. This is why our utility bills are so low. That may not happen in the future. If the price of natural gas goes up, in time, the profits of the utility companies should go up. That's if they produce their own green stock and so forth, especially the nuclear companies, which have fixed costs, but are still basing their pricing on what the government tells them to do, based on price of natural gas. So that's a very important thing, something I try to check on quite often, the price of natural gas. Now when I say quite often, not by the hour, by the week, by the bi-week, every so often. Yet if it increased 30%, we'd just hear about it in the daily papers. Copper is I don't know if any copper graphs in here, but that's also a commodity that's looked closely by businesses, by investors. It's known as Dr. Copper because basically anything that's used requires copper, be it computers, everything. It requires copper. So when the price of copper drops, as it has been for quite a few years now, it could be signs that the world economy is having difficulty. So, good thing to watch. Yes.
We know what fracking has done to crude oil. How about natural gas? Is there much being generated by fracking? Additional volume?
I wouldn't say fracking. I wouldn't say I'm an expert there. I wouldn't say fracking is a huge component of the natural gas reserves. We do know that, let's say, the largest natural gas of reserves in America, the company that owns it is Exxon. But they're really not tapping into that resource until the price changes, until it becomes economical.
I thought it was Icon.
Pardon?
I thought it was Icon, the biggest owner.
Icon.
Carl Icahn.
I know Carl Icahn. I didn't know he was the biggest owner of natural gas. Exxon is the biggest, most natural gas reserves in America. One of the top in the world. Carl Icahn, how much natural gas could he possibly own? I mean, Exxon bought XTO almost 10 years ago at a price you see the price of natural gas when it was a lot higher. I'm not going to go through these companies per se unless you wanted me to, but these are the next few pages. It's just a quick few paragraphs that I cut and pasted from my investment notes on each of the companies. If you ever wanted me to go through any of them, I certainly would. But let's actually go to page, if I have it. Let's talk about Bank of America, just one company, major bank, and why we own it. Hey Tom, did I disappoint you with not starting with the joke?
No, not at all.
I think I did. I think I did.
It's going to be at the end?
You know, last year I told the joke about the little boy in the train. I don't know if you guys remember. That was Tom's joke. And I should not have told that, so I learned my lesson. Don't tell any jokes Tom tells. Nothing, no horses, no whales walking into a bar, none of that. I'm keeping it clean, Tom. So, okay, getting back. So Bank of America, we discussed it a little bit. Why we own it? Because their book value is greater than their, typically, this is why we own a lot of the banks, as I said before. The price the markets we're paying to own Bank of America today is about, once again, I have to look at my, the price to book is 76%. Whereas it's been, before the crash, before the financial crisis, it was anywhere from 250 to 350%. So it leaves a lot of room for error, lack of execution, and it leaves room, I think, for the price to grow. But I believe there's great fear still in investors from the financial crisis not wanting to touch banks. And as many of you know, we like to buy into fear and sell into euphoria. And this is the Bank of America, Citigroup, and JP Morgan, I think, and AIG fit that mark well. What could happen to make book value go up more as well as the price go up more? Well, now interest rates are so low, as you saw. So the bank, and that's the core of their money is being made, is the difference between what they borrow money from and what they loan to us from. When and if interest rates go up, the amount they make, the spread, will increase, and that should affect their bottom line and increase their bottom line. That spread is called net interest margin. Like I said before, the credit quality of the banks is strong and expected to remain strong. The capital levels in their balance sheets are stronger than they've been in a long time. I don't recall if I mentioned, but each of the large banks, too big to fail, goes through what's called stress tests annually by the government. And so far, JP Morgan has been allowed to pay out greater dividends, where their dividend yield now is it's 3%, 2.7%. Citigroup, very low dividend, is at 0.3%. I believe as they keep showing financial strength, that the governments will allow the shareholders to now be repaid through dividends, and the dividend yield goes up, and perhaps the price of the stock goes up as well. But if you get a dividend raise, if Citigroup raises a dividend from 0.38% to 2.5%, well, now you have an annual added return on your portfolio of 2% for that position. Let me go a little forward now, off of even this, and nothing to do with this, and just talk about our investment approach, if anybody wants to hear that. We're often contrarian investors. We're almost the opposite of momentum. When everyone was buying the tech bubble, we didn't want to participate in that. We felt there was too much risk, and we went into treasuries. And frankly, back then, we were getting 5-year treasuries at anywhere from 7%, 8% to sometimes we were buying certain treasury closed-end bond funds that we felt people were trying to dump them to generate cash to go into the NASDAQ. So we were buying these. At one point, we got less than a 1-year term treasury to yield us 12%. I'm sorry, not treasury, AAA rated, typically government bonds, but they were not all treasuries. Being a contrarian investor is difficult because you have to fight human emotions. You're second guessing yourself. people would say, you own what? I mean, think about it. We own Microsoft, which we bought it when it was, it just a few weeks ago, finally went over its 1999 high, or 1998 high, one of the two. It takes a long time, so it's questioned as to why you own it. But we stick to our research, stick to the fundamentals, and typically that, not always, but will work out. Matthew, who I met today, is a mutual fan of Charlie Munger, who is Warren Buffett's longtime partner and co-CEO. And he says, in investing, when it's raining gold, reach for a bucket, not for a thimble. And that's what we try to do. I'm always looking at our research, trying to pierce holes in it, trying to see what's wrong with it, and see if we could find errors in the research. And luckily enough, it doesn't happen that often. Now, I did mention that we bought Valiant a few weeks back, after it all hit the fan. That's a special situation. That is not like a Microsoft. That won't necessarily work out. If we were convinced it wouldn't work out, we wouldn't own it. But we're certainly not buying more until there's more clarity to that situation. Interesting situation, but that is, I wouldn't necessarily call that contrarian investing, but that's more speculative. And in our portfolios, we'll always have maybe 10% of less of more speculative investments. Now, what I call speculative, others wouldn't. PBF Energy, I call slightly, it's not as conservative as the others, but it's a pretty darn solid company. It's always good to dollar cost average in your portfolio if possible, meaning on a regular basis to add more money, if possible. And that way you take, you're buying into the good and the bad. But if we see something's overvalued, we'll sit on cash. We haven't done it in a bit. And when I see our dividend yields much greater than the 5-year Treasury, it leads me to think that we're still in a good place to invest in the common stocks. Now, I could go on and talk about our holdings, or any of the holdings we have, but if I'd like to open it up to questions, as that was my big goal today, was ideally one day I'd prefer not to have anything prepared and just answer investor questions, but that could be a ways away. Does anybody have questions, or? Yes, Alan?
What sectors don't you own that you might be interested in going into that might be a good profit area in the future?
We typically don't buy by sector. Up until a few weeks ago, our portfolio was figure 18 to 20% utilities. One of our utilities, PPL, which you may or may not recognize within your portfolio, the old Pacific Power and Light, we sold it only because it ran up to its price where we didn't want to own it anymore. Utilities were hit pretty hard today, let's say anywhere from 1.5% to 4.5%. If that kept happening and the fundamentals of utility investing were intact, we'd want to own. That's a sector I would love to own, especially in this interest rate environment, because it's the most defensive sector I know, and I have a watch list that we would consider buying at certain prices. That's one sector we'd like to go into, but we're really not sector investors. It's funny, I was talking to Jim the other day about a company I don't follow, and I said, if this company got hit, if the price went down 10% or so, we'd consider buying it. Sure enough, today, that company was down 10%. We need not mention the name of that company. Banks, we already have a pretty big allocation to, so I don't see that going up in mass. So there is no real, we're really more company specific, knowing the industry and not sector specific.
More like other areas of healthcare or renewable energy or,
Well, we have a very big position in renewable energy, well, in energy. Boy, I probably mentioned this somewhere. When you combine our energy portfolio, which is about 30%, and our utility portfolio of, let's say, 15%, that's a big allocation. In our energy portfolio, we do have renewables, as well as in our utility portfolio. Most utilities have a pretty big renewable, utilities produce electricity and gas for us, and where does the electricity come from? It comes from natural gas, coal, not renewables, but also wind, solar, and hydro. So a lot of the companies, even like a PSE&G, has a big allocation to those energies. Now we also own, one of our positions is First Solar. First Solar is obviously a solar company, and they're a very interesting company. And basically they build major solar plants, major solar technologies, and they're not the ones that sell to, that put on the rooftops and so forth, but they sell to utility. A lot of their production is for utility companies. So we have big renewable there. We just bought a company a few days ago, also got hit a little bit today, called NRG Energy. They're located in Princeton, as well as Houston. They're the biggest, if I'm not mistaken, the biggest power producer in America. They have a big move in a big position in solar. PSE&G has over, and I have it in the notes here, I think it's over $1 billion in renewable energies. So we do have those sectors. Healthcare, we've owned Merck for a long time. We sold it because I thought it got too pricey and I was a little concerned with their finances. I'd like to own it again. We of course own Pfizer. And unfortunately, Valiant, which actually has probably will have $11 billion of revenues this year. Not a small company. I don't know if that answers it, but I think so. Other questions, please?
Have you looked at any transports, Mark? CSX or, JB Hunt or any?
Yeah, just casually, I have not. I have not had the transports. Of course, they're having a difficult year, the transportation average. After the market today, there was a big announcement, I think, is it Canadian Southern?
Canadian Pacific.
Canadian Pacific, yeah. So, but Jim, no, we don't have transports. Not that we wouldn't. I'm trying to think, have we ever? Many years ago, we owned airborne freight. No. Other questions? Anything in the world? Hard, difficult questions. Yes, Dr. Kress.
You mentioned you had 10 major holdings and approximately 30 all told. Give us a general picture as to what you retain in cash position to buy new holdings and what your costs are for buying and selling different stuff.
Sure. It's funny because I didn't go off my notes, and one of the things I wanted to mention is we're typically long-term buyers and holders. We typically own companies for a long time. This year, we have sold, other than cash generation, but we have eliminated 2 companies from our portfolio. One was PPL, which is a major utility, only because the price hit where we no longer wanted to own it. I'll tell you what, PSE&G came very close, and we did not sell it. But PP&L, a company we know well, we would buy again at the right price. If it goes down 10 or 15%, what a quality company, we would own it. But utilities have such a small margin of profit that it's not always going to, we're not going to hold it as we would hold a Microsoft, which Microsoft is at 53, and I believe I probably wouldn't even, unless fundamentals change, wouldn't even look to sell it at 80. That's where I begin to look to sell it. Unlike a utility, which is only supposed to make you maybe 5 or 6% a year, including dividend. Another company we've owned for a long time and sold this year was National Western Life Insurance. That's a company we loved, still like, but there was a situation that arose there. Once again, the reason we bought them is they're a stodgy life insurance company, and their price to book value was very low. At one point, it was about 25% of their net assets were, the price to net asset value was about 25%. You know, very interesting you say that also. So I get my books in the library, in Scotch Plains Library. The librarian and I, we get along real well, and he got to know me because I was taking out, I must have read 40 books on Lincoln, if not more, Abraham Lincoln. And he would always give me these books, but they're just not my style, and he's very right-wing conservative. I'm probably middle of the road, and he gave me a book that Huckabee wrote. I couldn't even read it. I read a few chapters. I had to give it back. So I had great pleasure giving him the book, Barney Frank book, back, and he was very disappointed. But I read Barney Frank because I love reading about the financial crisis. The Barney Frank book, the crisis stuff was great, but it was a little bit of, and even with Bernanke, I don't care so much about their life, their history. I just want to know about the nuts and bolts. But,
Did Barney Frank talk about his playing football in Bayonne?
not that I recall, but I did skim a lot. Did he play football in Bayonne?
I think so.
Really?
That's from Bayonne.
I did not know that. Yes, owner.
That's maybe.
He was doing sales, show 2017 as the bottom coming up, but maybe now looking at spring of 16, what's your outlook into pre-election period?
My outlook for what? For what the markets will do?
The real financial crisis coming up, the true one.
Let's see. One sec.
No, it's pretty serious.
Can you turn this off for that? For what I'm about to say? I don't know. I have no idea. I didn't know a true financial crisis is coming up. If I did, we wouldn't be invested. That's for sure. But I just don't, and I don't know what the markets will do. Will they be up 15%? Will they be down 15%? I don't know. They, I don't know.
You're not talking about
They'll either go up, down, or break even. I can promise you that.
the terminology used is bottom coming off.
I'm not familiar with it, owner. If it happens, it happens, and it might, but it might not. But you've always had those concerns, and even before we talked, it's always a difficult time to invest. I remember a client of mine, and I probably mentioned this in the past, said, I want to invest with you, but don't you think we should wait till things calm down in the Middle East? And I was thinking, when has it ever been calm? Has it ever been calm in the Middle East? I don't know, so I don't know. But it's a good question, but the truth is, no one knows the answer to that, and if they do, they're speculating. We do know pretty much for a fact that Microsoft and Exxon How will they do for their investors? We don't know, but we know that they're just so strong financially that if they fell apart financially, we're all in trouble. That's how I see it. Other questions, please?
The big three you were referring to an hour ago, AIG, Citigroup, and Bank of America. Are they now truly too big to fail? They were supposedly in '08. That's why they were forced the Treasury Department to save them. They were then too big to fail. Are they?
Well, the Treasury saved AIG for sure. I think if the Treasury had to do it all over again, maybe they would not have let Lehman fail. Maybe. I don't think they're too big to fail, and they're putting in structures to stop that. They're certainly not too big to fail for the shareholders. Let them, government, shareholders, you buy common stock, you're at your own risk. But as a depositor or as a recipient of an insurance policy, let's hope they are too big, that they won't fail us. I think their financial strength is showing us that they should exist. They are all of the banks are very strong, not all of them, but the majors are very strong, a lot stronger than they've been. So I don't know. But I don't envision horrible things. And if I envisioned horrible things for the shareholders, we wouldn't be part of it. Look, Citigroup, JP Morgan, all those, it would take a lot to make them fail. A Valley and pharmaceuticals, there's a lot that can happen to make them fail. There's certain, but I'm not concerned about them as a financial institution, any of those. Other questions? Yes, Doctor?
Yes, related to the banks, give us your opinion of the need for all the neighborhood banks that we have in the local area, all the new banks that have been built. Are they necessary? Are they all successful? And what is their future?
Are they all successful? I'm not it's interesting you say that because there is someone quite knowledgeable here on that, but I'm certainly not an expert on small banks. Dave knows small banks quite well, and I'm certainly not qualified to say whether there's too many or too little small banks and if they're profitable. I don't know. I'm sorry I can't answer your question, but I can't. And maybe afterwards talk to Dave and maybe. He's over there next to that, in between those two very pretty women. Oh, and Steve. Yes, Steve.
I was just curious, Ron, if you could give us an idea of some new things that are starting to bubble up on the horizon, maybe things that companies are starting to look at, maybe new companies or old companies that have possibly reinvented themselves, or anything. Just kind of give us an idea of kind of what's interesting to you now. Maybe that you're buying into through the companies that you're looking at, or not, or just on the radar.
Sure. There's a few of them. Well, one is NRG Energy. Now, I don't know if are you familiar with NRG Energy?
I've heard of them, but I don't know about them.
Do you know where their headquarters are?
I think you said Princeton?
Carnegie Center.
Okay.
So we did the 5K in the Carnegie
Yeah,
Center.
5K there, yeah.
Now, very interesting. So NRG Energy, one of the largest producers of power in America, a friend of ours has a 5K and that's run, or we participate in a 5K that's a charity for Parkinson's disease. We've been doing it probably almost 5 years. I'm not sure. And Andy goes and Steve, any others, and NRG had such a great presence there every year. So before this year's event, I started studying them, and I'm like, wow, look at these guys have gotten destroyed. Their stock has gone from, if I'm not mistaken, 60 to 25. And I remember telling my friend Andy here on a run, I'm like, we're going to see a big presence. Maybe we'll see a big presence every year of NRG at this Carnegie Center. But with the stock so low, we really didn't see much of a presence of them this year, which was interesting. I don't know if it's financially, if there's financial reasons behind it. And I keep notes, a watch list of things I wanted to buy, and NRG Energy was at $25 a share and said, I'd like to buy it a few dollars cheaper, but I might just pull the trigger and own it. But of course I had to research it. Well, I've been researching it and so forth, and it went to under 13 a couple weeks ago, and so we bought it. Would I have ever seen them if I wasn't in the Carnegie Center? I don't know if I'd ever recognize it, but that's how I became acquainted with them. There's a few companies that are on our radar that we have small positions that one day might be increased. Some are too small to mention, I apologize, but some of the bigger ones. Well, PBF is one of them, PBF Energy. I was telling Matthew, Steve and I, among some other people here, are in a running group, and I was telling Matthew over here, we met today, that I was doing a run in Parsippany, and I had long owned PBF Energy, and finally saw their headquarters on Sylvan Road. But they're an interesting small company that could become a lot bigger and a lot more profitable. But they are buying up companies, and anytime there's major buyouts and continual buyouts, there's risk of that things might not work out if they can't integrate properly. That's one of the things we're seeing at Valiant, which Valiant, I don't know if you're familiar with, but it's been all over the news, but went from about $260 a share to today it's at $70. Another company that I find, and none of these are recommendations, just companies we happen to own and follow pretty closely. Taser. You all are familiar with tasers? Taser Corporation. What now people are becoming more familiar with it. But what Taser's biggest product is not the stunners, but it's really the
Body cameras?
yeah, the body. What do they call it? The body cameras. But I'm sorry.
Body cam.
Yeah, well, body cameras, and there's another name, and I'm sorry, it's not ringing my bell. And they also own. So what happens is a police officer will wear a body camera, and you're seeing them integrated throughout the country now in many police stations. I have a few friends in the police force in Scotch Plains. None of them heard of Taser other than Taser. And I would ask them about it. Now, sure enough, Union County is being outfitted with Taser cameras. And then the beauty of it is it's uploaded to the cloud like everything else, and that they own evidence.com. So I find that to be a very interesting situation, also volatile, one with great risk. First Solar, another company like that. Well, not like that, totally different. First Solar is in the infrastructure of solar, primarily supplying utility companies with major multi-billion-dollar contracts, big solar farms and so forth. One thing I find very interesting about First Solar is that the Walton family owns greater than 25% of the company. That's just one of the things I like about them, and we'll see how time goes. First Solar is also an interesting company. They're so big and their projects are so big that they clearly tell the investors, we just don't know how much we're going to earn next quarter. We don't know. There's too many working parts. So we might think a project might end in 14 months, but it might end in 10 months. It might end in 20 months. So revenue and earnings are lumpy. And inevitably, every time they report earnings, if the earnings are below what analysts expected, the stock gets killed. That's when I like to buy it, and vice versa. When they've accelerated a project, the stock goes way up. But an interesting company. Now First Solar is, I wrote about it on page 31, so you can see a little bit about that. Another company we own, and And Jim can tell us why we own it. Overstock. Don't tell him, I'm kidding. We had a joke in the office about Overstock. Overstock.com, I am starting to lose faith in them. Probably not within. It's a year ago, 6 months ago, even 3 months ago, I would have said they were in one of those companies that fit the mold. But now I'm getting a little bit disappointed in them, and we'll see what happens. They're not doing terrible. Operationally, they're not doing terrible at all. But the owner, Patrick Byrne, is a little unusual. He has big investments in precious metals, silver, and what Dylan knows well is Bitcoin. And then I wonder who buys from Overstock, but they have over $1 billion in revenue, so someone's buying them, and they're trying to develop this Bitcoin trading system through which Patrick Byrne thinks will revolutionize investing. And cheapen investors for all of cheapen investments, the cost of investing when trades occur. And it just so happens Patrick Byrne is the son of Jack Byrne, who was one of Warren Buffett's early lieutenants. But it's a small holding of ours. I mean, it's our 22nd largest investment, less than 2% of our portfolio. I mentioned Taser, less than 1.5% of our portfolio, smaller investments. What I did find interesting is I went to Milburn High School, graduated in the class of '77, and one of my classmates went to Brigham Young, Oxford, and I forget where he got his law degree. What a smart man. And he's been with BitTorrent, Skullcandy, a few other companies. And just the other day when Overstock had their conference call, Mitch Edwards is now on that team. And that made me feel pretty good. He's a smart, honest guy. So, you know, I'm not writing them off at all. The investment has not been horrible for us. A few months ago, it was actually a real good investment for us. Any other companies that fit that mold? I'll mention it. There's a company called Canopy Growth. Formerly the Tweed, which some of our clients might recognize. Tweed is, or Canopy Growth, they changed their name. The operating company that we invest in is Tweed, and they're basically medicinal marijuana is legal in Canada, recreational is not, and they have a 25% market share. They're a strong company and an interesting company at that. Unlike the rest of the industry, they have no apparent shadiness to them. They have a Big Four auditor, and that could be an interesting long-term situation. But all the ones I mentioned, other than PBF, maybe First Solar, have some risks to them. And I was making a list. That's why I'm looking at my just various notes I take. And you know, you basically want to buy a Walmart when Sam Walton brings it public. Well, those are pretty tough to find, but you know. Other questions? Please go up and get a drink.
Ron, whatever happened to the land company we had in Florida? Remember that? We had a small
Yes, we
position.
still own it.
Yeah, there's still.
Another company that's disappointed me, the stock has not done horribly, probably pretty close. That is called St. Joe. And please, guys, get up, get some, feel free. St. Joe is our 23rd largest holding out of 30. The price is around the price is around 19, and we bought it just under 20, but it has been a period of years. I'm not saying it's a bad company at all, but the reason we invested in them because basically they own 2% of all the land in Florida. So we were getting Florida land at about $1,500 an acre is what it worked out to, or $1,800 an acre. Well, since then, they no longer produce their acreage. They've sold off a lot. They've become developers. So the reason I own them, or that we own them, was not for the same reason. I was considering selling the company, but they just brought back, I forget if it was 10 or 15% of their own stock at a price slightly above where it is now. So, and it's got some nice institutional investors. So it's a company we're holding for now, but if you do see it often, unless you, well, I won't say this for everybody, as we've been buying other companies, that is one that we relieve. But things don't always work out. And speaking of which, a very common investment, one of the things we like to see in our investments is companies buying back their own stock. So if a company has 100 shares and makes $100 of income, that's $1 a share. Well, if a company buys back all their stock and has 50 shares on $100 in income, now it's $2 per share. So if they buy at the right price, it could be a benefit to shareholders. You're seeing Walmart, and this is written in my notes if I'm not mistaken, Walmart and Microsoft, and Exxon, both are big buyers of their own stock. So it's interesting to see capital deployed in that way. I think I answered, right? Yeah. Yes, Matthew?
Have you looked at coal or coal bonds at all? Sort of as a contrarian play?
No. Coal, C-O-A-L?
Yeah.
No. Some of our utilities and NRG, which is a renewable company, surprisingly has such a big coal position. We have not. No. But most of the utilities have coal as a factor, and coal bonds I have not looked at all. Is that something that's interesting, or?
I think they're trading at pennies on the dollar, from what I saw.
You know, one of the things, one thing I didn't mention, we do our best, and I've mentioned this in the past, to be socially responsible investors. I don't think I really own a coal company, although coal is cleaner nowadays, it's supposedly, and we still own companies that participate in coal. I would not own a tobacco company, but I spent probably 3 days over the last 3 weeks studying a company that was coming public with a symbol PINT, P-I-N-T, a beer company that was going to go public. And I wanted to be ready. We don't buy public offerings, but once they went public and I was able to determine the valuation, we would have bought it. The name of the company is Ballast Point. How convenient is that? Oh, you won't own coal, you won't own a cigarette company, but you'll own a marijuana company and a beer company? Well, anyway, Constellation Brands, as many of you might know, decided to buy Ballast Point for $1 billion. So all that research is out the door. But we do not own coal. And socially responsible investing is very subjective. Many would say, oh, you own a tobacco company, you shouldn't own a beer company. So it's very subjective, and that's, anyway. Others, please? Yes, doctor?
You made a very interesting comment a few minutes ago about information that is uploaded into the clouds, and that makes it available to be downloaded anywhere in the world. Now, there must be some companies that are involved in that. What companies do you know of that would be profiting in that? Do you see any good investments in those companies?
Every industry has its good investments and bad investments. Just bear with me. I know the answer off the top of my head, but I just want to look at my thank you. All right, cool. Look at our top 10 list. No? Okay. We own a few cloud companies that are big in the cloud. One who oh, there you go, my glasses. Jim's son works for Oracle. Is our 19th largest holding, a big cloud company. One of the biggest cloud companies, or the biggest excluding Amazon, would be Microsoft with their Azure platform, Office 365 and so forth. I hate bringing up Microsoft to my computer science son because, but Microsoft is a major player in the cloud, of course, and bigger than Oracle in the cloud by far. I wouldn't consider Taser a cloud company. That would be the two major. Those are two major players in the cloud. Otherwise, you have Amazon. Well, there's a lot of cloud companies. Dell just bought EMC, I believe, who owns VMware, or a big portion of VMware. And then you had Oracle come out and say that IBM's, they never see them in the cloud, but IBM would disagree. I guess you heard this, right, Jim? And all they see in the cloud, all their competition is either Microsoft or Amazon. Amazon has AWS. But I think with Microsoft and Oracle, you have diversified companies. Microsoft's been big in the cloud for many years. Oracle's been entering it, and they're starting to show traction. But I don't think they're the no-brainer winner, like, nothing's a no-brainer. But Microsoft's pretty well entrenched and pretty well respected in the cloud, where Oracle is newer to that. Microsoft really is reinventing itself. You know, it's PCs are not what they were, so they really have developed products over a long time, and historically they did not have a first-rate product to begin, but then just became the first-rate product. And examples of that are Lotus 123 was the early leader, not early because VisiCalc was first, but then the early leader in spreadsheets was Lotus 123. Well, now Excel, up until Google, but still Excel is pretty much the leader. WordPerfect was the standard in word processing. Look what happened with Word. Netscape was a browser, and then you had Internet Explorer. Granted, well, now Internet Explorer is called Edge. Now there's a new one called Edge, and so forth. We've had so many discussions within the house there. Xbox was not a leader in the beginning. They were really didn't have a great product. Windows, Apple was the original graphical interface, and then Windows did quite well. Now you have the Surface, which really was pretty much a garbage machine to begin with, but starting to become gaining a lot of traction. Now you have the Surface Pro 4. And now you have the Surface Book, which emulates a, what is it, the Mac Air? Is it Mac? What is the Mac Air? But now the Mac has come out with a Surface Book clone, so it's an interesting thing. So you never count them out. One thing was funny was they had their and a lot of what powers Netflix is a Microsoft product, Silverlight. Things that you use every day, your database for your tax program, and I forget what other the document management system is SQL. That's a Microsoft program, SQL database. SQL. I remember, I don't know if you all remember the Zune MP3 player. And I saw Steve Jobs interviewed, and they go, "Are you worried about the Zune?" He's like, "Why would I worry about the Zune?" Oh, somebody said, "Oh, it's supposedly gaining traction," in an interview. And Jobs goes, "Have you been drinking? Have you ever seen a Zune?" And it was an interesting comment. Anyway, that somewhat answers. But they are somewhat a progressive company. And now what they've done that's very interesting is they've taken their full office products, where we used to go and buy it, own it until the next version that you want to own came. And now they do a subscription service like so many other companies, Office 365. And for something like $10 a month, you could put it on 3 computers and you're always updated, which is with a full Office suite. So it's really an interesting phenomenon that's going on. And they seem to be gaining traction and doing well. They are no longer, I think you'd agree that they are starting to be recognized as a interesting in the tech industry. or not. Excuse me. Other questions? Yes,
So you
Matt.
mentioned Valiant a half a dozen times. There's so many other biotechs out there that could be very appealing. Biotech has been one of the best performers year in and year out for 10, 15 years, until someone tweeted recently. But that's a whole different story.
Until someone who tweeted that, I
Who
remember
was
that.
that on September 21? On September 16, the NASDAQ Biotech 100 was up 16% year to date, when S&P and the Dow were in the red at the time.
And that's when Valiant was
Right, so they
flying high as well.
Right, they bounced back about 8%. But my point is, you like to buy into fear. How come you're not looking at other biotechs to buy into? And why has Valiant always stuck out for you anyway?
Valiant is not a biotech. Valiant's major
Farm.
Valiant's major products are gastrointestinal and dermatology. I've known Valiant for years because some of the value investors that I watch closely, specifically Sequoia Fund, which was really an offshoot of Buffett in the early days, was an early investor in them. And Valiant just, today they hit a 3-year low in price, but they have just accelerated like, they were a very profitable company, stock market wise.
They kept eating up the companies.
Yeah, and killing their R&D.
Right.
Yeah. So I've always, and I go to the Sequoia annual meeting every year. I own shares in Sequoia just so I can go to their meeting. What a great meeting. 3 people are allowed to ask Warren Buffett questions, one of which is John Brandt, one of the portfolio managers of Sequoia. Well, Valiant became a 30-some-odd% position in Sequoia Fund. Well, boy, has that hit the fan for them. So, a company I've always wanted to watch, couldn't understand. When their price went down 70%, we bought a small position. I did as much research as I could. They've removed all guidance, so anybody's research is up in the air. And based on their big decline in price, as well as major investors that I look at, owning them, Value Act is one of the big owners who took a big position in Microsoft, still has a big position even though they sold some. They own over 20%, still over 20% of their portfolio is Microsoft. There was a lot of admired investors. Bill Ackman from Pershing, and that's why I own it. Interestingly enough, their return on equity, if their numbers are real, because they could be an Enron. And that's why our position is small, because we don't have the conviction. Smaller. And let me give you an example. They are our 20th 20th largest investment out of 30, so they're not. Our 20th size investment. Their return on equity is fantastic. They have over a 40% return on equity. Their price earnings ratio is well under 10. But if the authors, and I believe it's the same author, that Roddy Boyd probably wrote that biotech, did he? Or Surf?
Not sure.
Okay, so if this person who was shorting Valiant, who no longer has a short because he said it,
Well, that was Citron they were involved.
Citron, yes, who played it out,
Right.
no longer short. If their research is correct and they're fraud, then forget it. The returns and equities are BS. But if they're not, it could be a very good value play. But, like Seth Klarman, I believe, says, value play, value trap. Which is it?
Right. So I guess I'm still saying that, what about some of these biotechs that have outperformed for years, even though there's an interesting situation?
I just don't follow them, Matthew. I just don't follow them. Very often the biotechs, I say, well, you know what, we own Pfizer, we used to own Merck, and they're in the heart of it as well, but they're a more conservative way of playing it. But typically we're fairly conservative in our companies we own. You see our top 10, I guess,
Right.
other than a few would be considered conservative. Let me read you this is as the other day. Our 11th is Walmart, First Solar's 12th, Intel 13.
Yeah, so they're massive.
Yeah. First Utility 14, Pfizer 15, NRG 16, Chevron 17, ConocoPhillips 18, 19 is Oracle. So there's a theme of we try to stay defensive and conservative, and biotechs don't necessarily fit that mold. I do like to find, I like a margin of safety, so I like to have, if things don't work out, if things don't pan out operationally, some type of cushion, if possible. Generally, but not always. Yes, Dave?
Well, first, I wanted to thank you for hosting this event tonight. It's
thank
really
you.
nice and really appreciate it. It's pretty rare that a manager gives access to everyone like Ron does, so I want to thank you for that. And I've seen Ron in action. I've gone to a couple annual meetings with him, and he's tenacious. He really digs into all the numbers, and you guys are really lucky to have him, investing on your behalf.
Hey, Dave, I noticed in the last meeting you didn't want to, you had to limit our association.
Well, I'll let you just do your thing. You really ask good questions.
I yelled at them for paying themselves too much rent.
Yes. One thing for like many years, the market can outperform, but things can get frothier and frothier. So, in terms of the portfolio you've constructed versus the market today, what's the difference? In terms of like generally the valuation ratios of what you put together, because I think that's kind of a telling in terms of the conservatism that you implement.
Right. Thanks. It's interesting, if you don't mind me saying, Dave read some of my writings, just like Matthew. We kind of met from the internet, and Dave the same way, maybe 2 years ago or so. It's been a nice association, and he's a professional investor himself. So thank you for those nice words. And we don't necessarily look at the market as a whole. Of course, generally, with the S&P, some of the fundamentals and so forth. And the price earnings ratios, I don't know, are they 18 to 22 right now, I guess, in the S&P. Price earnings ratios, and historically, price earnings ratios have been, let's say, 15-ish over history. Our typical holdings as of now, although energy kind of excludes that because their profits are way down, so their price earnings ratios will go up. But let's look at our top 10 holdings. AIG has a forward PE of 13 and a price to book of 0.71. I think rather than go into each one, our typical PE is on the low side, probably 13 times earnings or lower. Our returns on equity are typically higher than the PE, unless the book value is much less, than the price to book is much less. And our price to books are typically less than the typical, S&P company. So I think there's some defensiveness there just because of the prices we want to own it. And frankly, maybe that's part of the reason why we like to get to know the companies, and maybe that's why we have 30 companies and not 60, 70, 80. A few of the companies have higher PEs, but it's a select few, and hopefully they'll grow into their PEs. Price earnings ratio is PE. And does that answer your question, or do you want me to elaborate on that?
Oh, that answers it, yeah. I think generally, you're running, a pretty good discount to market, and I think, over the long run, that's probably a smart thing to do.
Well, we hope so, yes. And we do try to buy discounted. That's just my, what do they call it? My persona, the way I am. I just like discount, we have a joke in the morning. I'm in charge of making coffee. Kim's in charge of cleaning it. But sometimes she forgets, and she's like, "Oh, don't worry about it. I'll go to Dunkin' Donuts." I'm like, "No, you can't spend $1.50, and then I'll clean it and make it." So we try to be as frugal as possible. It's just out of fun. It's kind of anyway. Other questions?
Ron, how about the 10th one here, Exelon? What sort of company are they? Are they energy also?
Oh, well, Exelon's the largest. Exelon's a utility. They made a failed attempt several years ago to buy PSE&G. They're just a major utility. I forget the name of the company, symbol POM, which we used to own. They're looking to buy them out. So they're just a major utility selling at a low price to earnings ratio, regulated utility, well respected. Oh, they bought Constellation Energy, if you remember them, and they might hound you for getting better prices, but be careful if you do that. But Exelon's just your run-of-the-mill utility, just like PSE&G, just like First Energy, which we own. First Energy owns JCP&L. And Exelon is just your typical utility company. But the big part of Exelon is they are the biggest nuclear operator in America. Other questions? None. There's any investor concerns that you want to discuss, or anything?
I have one quick question.
Yes.
You mentioned beer and tobacco, and you wouldn't invest in tobacco. I'm going to say, and you can tell me if I'm right, is it because it's futuristic, it's declining, and that's something that you wouldn't?
No, because that's only, we used to own Philip Morris. When Philip Morris, and the way I, the brain works very interesting. It's a very interesting way the brain works. The way I substantiated, okay, I don't want to own a tobacco company. This was prior to '94, because I remember your dad was still alive. And we would talk about it. I'm like, oh, how convenient. I don't want to own a tobacco company, but they're also 50% food and beer, so it's okay. As soon as they spun off craft and the beer operation, I forget what it was, we sold it. I just didn't want to be a part of it. But it had nothing to do with the decline in consumption.
Not smoking as much.
No, it had nothing to do with that. No, it had nothing to do with that. It was supposed to, I just object to cigarettes, so I didn't want to own it. And it's very subjective, and it's not necessarily correct.
That's understandable. What do you think of craft?
I don't follow it. I don't
Is there a
follow
reason
it.
why, or?
Oh, because you can only follow so much, and it's just not on my radar. Now, this is a book I keep of,
That doubled too over the past couple of years.
well, a lot has, a lot has. Well, I was thinking about it today, like we own Pfizer. Well, Pfizer was 8-something in the financial crisis, and now it's 34. You know, Microsoft went to the teens, and now it's 50-something. So a lot of companies have done quite well since then. But of course, Kraft, a quality organization, we just don't.
Yeah, right, you can't, and BlackRock, that was the other one.
BlackRock? BlackRock is a company I've wanted to own since 2008, and I haven't.
Excellent, I work there.
Oh,
I haven't
really?
worked there. I'm
Now-
at Morgan Stanley now, but I have.
Oh, BlackRock, what a fine organization, and I like seeing who's the owner, Fink? Who's the
Yes, yes.
boy? He says what's on his mind.
Yeah.
He says it's so. Yes, I've always kicked myself for not owning it, and they're in my book.
Morgan Stanley has its employees investing in the BlackRock fund.
Mhm.
Yeah,
Yeah,
there's
wow.
different ones, so.
Yeah. I had mentioned that we bought a closed-end treasury fund in the late '90s, and that was BlackRock. Maybe it was 2000, because it was BlackRock 2001 Term Trust.
Okay.
And so we were buying a portfolio of, I think it had 11 months to go, and it was selling at 85 cents on the dollar, so it was just a slam dunk.
Yeah.
And it was my understanding that BlackRock, even if they didn't hit net asset value, they were a growing organization, they were paying everybody off on that anyway.
Right.
So-
What year was that? That was.
I'd say it was 99 or 2000. Were you there then? You're too young for
No, I
that.
just was there in 2015.
Oh, okay.
Yes, I just did a short-term
Yeah.
contract.
Oh, great company.
Yeah, it's excellent, yep.
Yeah. So
Very
great.
well managed. too.
Yeah, I would love to own that, but now they're big into ETFs and there's a lot going on, so I'm a little concerned with them. And at the right price, I'd love to own them for a long time.
You will.
Maybe, yes. Other questions, please? Well, I think if there's no other questions, we have this room for another hour. Feel free to get wine or beer and ask me questions or anybody. And I thank you very much for coming. We value you being here and being our clients, if you are, a great deal. And for those who are clients, we're thrilled to have you, even if you're never clients. It's really a pleasure to have you all. Thank you.
Thanks, Ryan.